Ladies and gentlemen, welcome back to the Capital Flows live stream. We are in the day right after FOMC. We just had the PCE print. We are seeing a lot of different signals moving in lockstep with a lot of the macro views, the thesis, the ideas that myself and James have been talking about on streams every single day. And what will be important today is to really dial into how to think about this PCE print, how to think about it in relation to positioning, the hedges that unwound yesterday in the FOMC meeting. How should we think about that as it relates to the overall picture? ES kind of ticking up off of lows. How long can that continue? Those are going to be all of the topics that we cover today. James, thanks for hopping on. How are you doing?
Let's go. Back in action here in San Diego. Conference, Bitcoin conference was okay. Nothing crazy. It was fun to watch some of the earnings fireworks yesterday. we are starting to see some really, like, we're starting to blow people's minds on the possibility of moves in these big companies. You know what I mean? Like 10% moves, 8% moves. I know it's earnings and stuff, but like these are $1 trillion companies. And I just think that goes to show you that you go down the market cap stack to companies that are a couple hundred million, few billion, 100 billion, like we're going to see some crazy stuff for the next couple of years. And I think that's why it's so important to just lock in.
Yeah, I agree. I think that we are, the entire moves that we are seeing right now, and I keep trying to explain this to people, that you should expect, gap ups and overnight to just bid so aggressively when you're in a credit cycle melt up and you have so much money in the system. And I've laid this out multiple times on the website. And again, if you were here, if you are at capitalflowsresearch.com, you need to go through all the research. Spend time going through everything. I'm laying out a section, every single slide deck that we go over. It's all going to be on here. So I strongly encourage you, be on the website, go through, subscribe to everything that's taking place, go through all the educational primers right here. But the thing that I laid out yesterday, and again, I know that in today's world, people don't really want to talk about their views on social media, because if they do, then if they're wrong, they get absolutely cooked by all the trolls. And for me, as a risk taker, someone who is just spending time in financial markets actually trading, my entire goal is to be able to run risk in markets and operate there efficiently. Not, I'm not at the mercy of all the trolls. And so I think that's one of the important things is, if you have a view, talk about it. Spend time thinking about it. Get feedback on it if you need that. And that was one of the things that I laid out yesterday, and it continues to be my view. Could I be wrong on it eventually? Yeah, maybe. I'm going to manage my risk around it. But as I said yesterday at the FOMC meeting, that we are going to bid. And that was my view. Could I have been wrong? Yeah, sure. But the entire macro flows that we're setting up continue to show the high probability of hedges unwinding and a bid in the S&P 500. And not only that, but James, you can expand on this a little bit. Yesterday, we talked about really the bouncing off of this line in the Z7 contract. I mean, we went over the entire thing yesterday about this level in the Z7 contract and why there's limited downside here in Z7 and how that connects to equities and FX. And I talked about Euro USD and these other pairs are likely to bid. And so,
and crude as well, right?
Oh, crude coming down off the highs just a little bit right now. We bid a little bit into the meeting, a little bit more than I actually expected, and we've come back down. I mean, I think we're going to move lower in crude. That's just what I think. And then you have gold and silver ticking back up from these lows, which I think is going to continue as well. So again, I covered this in the live stream yesterday, and if you really want to understand these flows, you need to invest in being in the live streams every single day and also reading all of the research on the Substack. I'm going to be laying out a lot more in-depth mechanics on the Substack for mapping these flows so that you understand the why behind them. And so that's exactly what we are seeing. Like I said, the whole metals complex is really primed for upside right here. And I think it's just going to continue. And so the flows that we're seeing are moving in lockstep with the inflation, real interest rate logic, and everything that we are laying out on the stream. Now,
before you go on, can I just add on to that a little bit? Like just to hammer your point home is like yesterday we literally talked about what we're seeing now. And I just wanted to say that's the importance of kind of trying to follow along here and understand kind of the mentality behind a lot of what you discuss, right? Because now we're at this point where we understand a little bit better about what we're seeing today. And the whole goal of like all of this is to be able to like look at markets and be able to better understand what's going on so that you can place risk better. So I just think it's cool to have seen what you discussed literally happening in real time. I think that's awesome.
Yeah, I think the real time element is helpful for people because then they can see how you think through things under uncertainty and how you place your bets. And I think that's what you'll always see with practitioners is you'll see they'll say, yeah, maybe this will work, maybe it won't, but here's how I want to position. And you'll see it happen. And it's not retrospective bias. It's thinking through, oh, where did I get that wrong? Or you know what? I actually made money, but it was for the wrong reasons. And I actually made a mistake there. And so I think that's really key. And then, this is, for the trade that you talked about, I think this was this past week, or was it last week? On Qualcomm.
Yeah, I was talking about this back when it was at like 135 or 132 or something like that.
Yeah, so that's James basically came on one of the streams. What was it, 135? Basically right here, we did an entire this area. We're not going to get
whatever.
Yeah, James put an entire deck together and we walked through it, and basically talking about the catch-up trade in Qualcomm. I'm not going to remember what live stream it is on. You should go back and just watch it, or you should just be on the live streams every single day. But now, I mean, having this type of view or just being aware of it, and then now we're up 44%. I mean, that's a pretty significant move, especially in a single name stock. If you're saying, oh, let me just buy some calls and being up 400% or 500%, right? So, we're all of these factors, right, where we're seeing the equity side of things and, how exactly those are playing out. I think are all playing into this larger macro picture about where we are in the credit cycle. So, James, you want to comment on this and just kind of some of your mindset now on Qualcomm and how you've kind of been playing this and thinking about it?
Yeah, Qualcomm's just an interesting one. I could probably send you, if I could get it to where it's not like going into my Claude database, I could probably get you a thing to attach to one of your articles so that people could see like the thesis behind it. But generally speaking, it's like a semiconductor, AI, memory, automotive, personal, on-person device AI play, right? And it's one that's been forgotten. Nobody talks about the CEO. Nobody on FinTwit discusses it. It's a couple $100 billion company, or it was 150 billion dollar company, and all the other ones are testing or above $1 trillion. And I talked to some people. I live in San Diego. It's where Qualcomm is. I know multiple Qualcomm employees that are always just so bullish the company in general. They love what they're doing. They love their CEO, like all these things. And then I look at the chart. It has this capitulatory wick below while all the other competitors are doing well. If you go to like the longer term, you do a weekly chart, you draw a line, you could see that it had this kind of capitulation wick below the range, really backfilled it back into the range. And I was like, okay, this looks like a really great risk reward. The downside's really limited. The upside catch-up trade going into earnings is pretty nice. Everything else like Intel, NVIDIA, AMD, they were all bidding. And I'm like, all right, if there's a good chance, it's to go now. So I positioned into this with leaps prior to earnings. And obviously, with some luck involved here, it's up. But now to your general approach, I'm on sides, right? So now I have a clear head. I can kind of decide, all right, well, maybe I want to take a little bit here. Maybe I don't. I don't really know, but it's up to me now. And that's the benefit of like trying to be able to kind of come up with the idea early, position well, limit your downsides, get on sides. And that's the whole point here.
Yeah, agreed. I think this goes back to when you're on sides, you care a lot less about what other people think, right? Because then you have this cushion and you say, okay, now I can figure out, I'm working from a position of strength, so I can make a lot more mistakes and still make money, right? And you still want to limit those mistakes, but it allows you to take more risk in many circumstances and lean into any edge that you do have. So I think that is just really key to, talk through these examples in real time that we're trading, we're talking about. On
you
Go ahead.
Real quick, I forgot I did put it on a website, so I'll just put it in the comment section here for you guys if you're interested, and you can go
Cool.
look at the Qualcomm thesis.
I'll also link it afterward. So anyone who's here and they're saying, "Oh, I want to go through all these on my own," I'll give you this entire dashboard, and then we'll get you. If you're a subscriber on the Substack, you'll get a email later today, and you'll get what James is sharing right now and the slide deck that we're going to go over right now. So we'll always make sure that you get everything in the live stream. One of the things that I like about these live streams is, one, they're recorded, so you can go back and listen to them. Two, what I always try to do is in these live streams, you don't need to take notes in them, because we're going to give you all the deck. It's recorded as well. You can download the transcript. You can have AI synthesize it. What you should do in this live stream is spend time thinking about questions that you can ask and interactions that you can have with us so that we can talk about how we think about things. And so if you are in this live stream, what I would encourage you to do is, one, if you're on Twitter, if you can retweet it so that everyone else is aware of it, that'd be amazing. But two, spend time asking questions in the chat. Questions are free on call options. So don't ever let free call options go to waste. So that, and we might not know the answer to every single thing, but we're going to know where to get the answer for whatever it is. And we'll either go find it or we'll direct you in the right direction so that you can go talk to someone who knows the answer to it. And that's the entire point of trading, is figuring out, oh, you know what? You should go talk to this guy, or go think about this thesis, or go read this, whatever it might be. So everyone, if you're here, we'll be covering that. Real quick question, why don't you cover this, James? And then we'll go into the slide deck that I have and talk about where we're at in the credit cycle.
Question by Alfie. How do you think about getting outside to break even versus adding to winners, basically taking risk off versus always trying to break even? I don't really do the whole, just a quick note. I know a lot of people like to move stops to break even. I don't really do that. I usually try to take close to the most amount of risk I want in the trade right away. I don't generally take like small positions and then to kind of decide, do I like it? I kind of just, because I limit my risks so much that I just like getting my position on. If I'm on sides and I think anything's changed to where I'm like, you know what, if we go back to my entry price, I actually think I'm like invalidated, then I might justify moving my stop. But if not, I'll just leave it and let it play out. When it comes to adding to winners, I don't do that. I know Flows talks about this as well. I've never been great at that. The only times I'm better at doing that is if I think my conviction gets better. Like if I think the trade gets better, then if it dips, I will add again, right? So like I did this with PER, right? Like I put my position on PER. I also own Hype as a token, but like I kind of think a little bit into it, I realized how powerful Hyperliquid is and stuff, and I added to a position on dips. So that's how I think about it. It's to each their own. I really like to lean into like what I prefer, whatever's going to make me stick to my process the most.
I like it. Cool. All right, everyone, keep asking questions in the chat if you guys have anything as we go through these different ideas, and I'll go through them as we go through these streams in this deck. What I did today, and I really did this because I think I've gotten a lot of questions from people, and also I just think this is very critical to know today and tomorrow, and this is really where we're getting, taking a larger concept and connecting it to where we are in the bigger picture. So right now, for again, reminder, everything's at capitalflowsresearch.com. Go there. All the paid research sent out every day. I've been talking to paid subscribers on there last 2 days with some more in-depth research talking about some positioning things that are very important. But what I want to talk about today is the yield curve and how to think about that in the macro universe that we're in. Bull steepening, bear steepening, bull flattening, bear flattening, and how you want to think about the signals in them. So the curve itself is not inherently a directional rate signal, because the yield curve can move up or down and not necessarily imply the next move for directionality of interest rates. The key way to understand that is understand the type of curve that we're in. That begins to give you insight into what's taking place. So every macro story collapses into the curve. So basically growth, inflation, policy stance, dollar direction, credit appetite, equity rotation, all of it shows up in the yield curve, where the front end sits and where the back end sits. And that's what I want to really cover. The four major regimes are bull steepening, bull flattening, bear flattening, bull steepening. And these regimes, they each represent where the Fed is either making a policy error or correctly mapping their action to the situation. So are they ahead of the curve or behind the curve? And then are they ahead of the curve or behind the curve relative to growth and inflation expanding or contracting? I know that sounds like a lot, but once you begin to intuitively understand this, it is going to make the entire macro regime much clearer. So we'll go through examples on all of this, and I'll give you a model so that you're able to map all of this in real time. And you can even take this entire slide deck, feed it into ChatGPT, and ask it to do for you. Do the same thing that we're doing here for you. So bear steepening, bull flattening, bear flattening are, simply put, if we have, basically this bear steepening or flattening, all that means is that bonds are going down, or, you have interest rates going up. But basically you have, just think about ZT and ZN in the CME futures, they're going down. So anytime you have bear, then you have interest rates going down. And interest rates going up and bonds going down. When you have it bear flattening, that means that the curve is flattening and you have bonds selling off. When it's bear steepening, you have the curve steepening and bonds are selling off. Basically, the opposite is true here. If it says bull steepening, then you know that bonds are bidding and ZT is bidding and the curve is steepening, and the same thing for the bull side, for the flattener side. Both can take place. And the key thing to recognize is that the yield curve in itself, you can remember we flattened during this period of time right now in 2022, and it was a bear flattening because the Fed was hiking rates. Inversely, you have periods of time where the curve, for example, in 2018, especially in this 2s10s curve, I believe it's 2s10s right here. Yep. In 2s10s, you had the curve flatten, but you had bonds bidding the entire time. So you had bull flattening. So you have flattening and steepening, but the key thing is connecting that flattening and steepening to where we are in the cycle overall. And this will connect to earnings and where we're at right now. And what I want to do really fast is if you are following along on everything that we're doing on the Substack, all the educational primers are right here. In the educational primer section, you scroll down, click on the yield curve model from TradingView. Click on that, and that will bring you to this exact page right here. And I'll begin to explain kind of where we're at with things. And you can go to this TradingView model right now. I just put it in the chat. You can go right here and pull up this exact chart, and you can walk through it with me. And the yield curve indicator at the bottom is there for you, 100% free. You can go through that yourself and change any of the tenors there to be able to understand where we're at. So what I'm going to do is I'm just going to set this to 20 days, which says what's the 20-day look back. And you can begin to see the different regimes right here. Now, when we begin to connect this to where we are in the 2s10s yield curve, this will begin to tell you why things are happening in the way that they are. So when you have bear flattening, like we had right here, what you would want to do is say, okay, let me go back to the slide and say, what happens when you have bear flattening? You have the front end rising faster, or the front end repricing faster than the long end. And that really connects to the Fed's stance in this period of time. And what I would say is that right now, we have flattened pretty significantly right now, right here. And we are now in this range for 2s, 10s. Now 2s, 10s, 2s really connect to nominal two-year interest rates, really connect to where we're at with we had this move down. We're in this range right here. 2s really connect to where we're at with short end rates and the Fed and all the SOFR contracts we always talk about. 10s connect to long-term nominal GDP. So when you look at 2s, 10s, you have a connection to short end rates and long-term nominal GDP. If you look at things like 10s, 30s, that really connects to long-term nominal GDP and the spread between it. So where are we at?
Sorry, could I just ask for a clarification?
Yep.
Is it usually listed this way, 30 to 10 or 10? When they say 10s, 30s, is it you're putting in the 30-year minus the 10
You put
year?
the 30-year for in first, yeah,
Okay.
right here. But they say 10s, 30s.
Yeah.
It
Just in case it's like a little confused.
No, that's helpful. Thank you. So again, you can pull up this trading view model yourself, right? You can go in the comment section and grab that. And the idea here, and we'll kind of connect this to where we're at, is if 10s, 30s, I watch this all the time. And actually I have this chart of it, I think. Yeah. So, you can see right here how 5s, 30s is higher than 2s, 10s. So think about this. This is longer duration. It's 5s on the short leg and 30s on the long leg, whereas you have 2s on the short leg and 10s on the long leg. Why does all that matter? Basically, you have more sensitivity to the long-term nominal growth in this curve relative to this curve. So this is really key because when you see this at a higher level, especially where we're at right now, that is telling you, at least where we're at right now in the cycle, that growth is still resilient in the economy so that you actually have this spread right here in the curve indicating that longer end rates are higher. And I'll go through a bit of a visual for this. What you have is, the curve can move up or down for 2s, 5s, or 10s, 30s. It can move up or down at any time. And that connects to inflation risk in the system. And so what we have for the risk, the entire risk right now, and this will connect to the core PCE print that we had today. If we have the curve bear steepen, which means that long end rates begin to blow out, they don't kill earnings because long end rates are blowing out because inflation is rising. Typically, you have some government spending that's a little bit excessive. And then you also have maybe some stagflation, but it's more likely just really strong growth and inflation on the long end. This can kill or decrease equity multiples because you have interest rates moving higher. So if you think about every single thing functions on a risk curve. And if you have a shift in the risk-free rate, which just goes back to if you need to understand interest rates to understand everything, if you have long end interest rates move up, that shifts how people want to allocate their capital because now they can say, oh, well, I can buy the 30-year bond at a 5% yield now, and that's a lot less risky maybe than buying the S&P 500 at a 2% yield or a 3% yield or something like that, a risk asset. And so people are always going back and forth in that mechanism, and that is always dynamically changing as the Fed, because the Fed is primarily moving the short end, and then growth and inflation move the back end. So that's why we always talk about, the Fed only controls the short end and the market controls the back end. The back end is really what you want to understand for what is the risk to equity multiples and how does this measure against this. And so that will be one of the key things to think about as we talk about this PCE print that came out today. And so let me go to this PCE print. If we go to the PCE model that I run, here is the headline PCE print. You can see right here that we have headline PCE. It came in basically in line with expectations, but it accelerated 70 bips on a month-over-month basis for the March 26 print. Now you'll notice that right here, here's the long-term chart of PCE. We had the inflationary cycle where we're at 7.2%. We came down significantly, then we just ticked up in headline. So if crude remains at these levels, we're likely to see this type of projection. The inflation swap curve is pricing this direction right now, and this type of direction for month-over-month prints. So this is going to be a very important thing to watch, because right now the market's saying we don't really think that inflation is going to blow out. It may rise a little bit, but the entire question is how much is it going to fit into core? If we go to core PCE, that ticked up a little bit, but not significantly. If core remains contained, that is likely to keep long end rates below their levels, and we're unlikely to blow out in long-term rates if core remains contained. That's why this entire dynamic between headline and core is so important right now, because if you have headline remain contained, that increases the probability that we don't blow out in long end rates. So for example, if we go to the 10-year right here, and we think about where we're at, we covered this a lot yesterday in the stream, but I'm going to go even deeper today. On 10-year rates, if core begins to really rise significantly, we could see the 10-year move up, kind of to these levels right here, maybe just a little bit, and then kind of come back over. Because, overall, we don't see the same amount of growth in the system or tightness in the labor market that we had previously. And so that could move up a little bit if core begins to get hit really hard. If it doesn't, what I would say, which is actually, I have a bias to think that it's we could have it transmit into core a little bit, but not significantly, which is why I've talked about this downside level in Z7. This is the contract that prices cuts between now and the end of 2027. And why I said yesterday that we are likely to bounce off this level, which, basically perfectly. And this is an indication about how many cuts we have on the forward curve right now. And so I don't think if we remain with the same inflationary impulse that we have right now and it doesn't transmit into core, this level is likely to hold. And we're likely to move up from here. I don't really want to bet on the upside because the upside is limited. I would say it's basically a coin flip, but there's limited downside. So this is a great example. And James, maybe you can touch on this a little bit. Right now, the Z7 contract is, it has limited downside, but it doesn't have significant upside. So it's kind of neutral. Do I want to trade it? Maybe here and there. It's like batting singles. What I want to think about is what are the second and third order effects of this stain like this, which if we connect this to, again, what we talked about yesterday, and I put this on Twitter and put it in the chat and everywhere else, basically explaining this, is there's a reason why ES made its intraday low at this same level as the Z7 contract. And we even talked about this on stream, where we just said, yeah, if we move right down to this level in ZN or Z7, that is going to probably set some type of bottom in ES, which is exactly what we had happen right here. And now we have ES outperforming and bidding as Z7 is likely neutral. So it's those types of, it's understanding interest rates in that framework that is really going to be valuable, because those interest rate differentials directly connect to things like the dollar and Euro USD bidding off these lows, which again, moving in lockstep with this Z27 contract, which is pricing how aggressive the Fed is being. So, this is, like we said yesterday, all of these flows are connected. There's a direct link in interest rates to every other asset in the market. So, James, how would you think about something like that? What would you kind of, go over when you're thinking about, you have this baseline of this one contract, but you're thinking about what are the second and third order effects and what's the best way to express a trade?
Yeah, I think the foundational part of that idea is the SOFR, like the Z27 SOFR curve, right? Like we talked about yesterday. So if that's reacting in a way that you think, And we've talked about the downstream effects into like gold and silver, crude, equities, things like that. I would then start to think of like, okay, what are the things I generally like to execute in and feel best at? Is there an impact on those? If so, what do the charts look like? How do I want to express that trade? What's my risk reward? I start game scenario planning all of those yesterday so that when you see that reaction today, I'm ready to pull the trigger, right? And we have a more clear outlook on like, well, okay, now I can pull the trigger in the downstream kind of asset that I want. And then I'm going to go back and use that foundational level in like the SOFR curve or crude making an all-time high or whatever you kind of choose as like my I'm wrong, right? Like,
Right.
so you're able to determine your risk pretty well, maybe over here, but actually implement the trade over here where you're more comfortable. So for me, that's like, I don't really want to trade SOFR. I don't really want to trade equities at the moment. Like, I'm not necessary. So like I go out and I'm like, okay, well, I'm very comfortable in the oil markets, right? So maybe I'll take an oil short if I see a chart situation where I'm like, ooh, it looks weak here. I want to see some follow through to the downside, and I'm going to cap my exit at like the recent Brent highs or something like that. Then I can monitor the trade, look for asymmetry, look to get on sides, and go from there. And maybe you want to express it in gold, right? Maybe like
Right.
maybe you see, oh, this is a good spot. I want to bid in gold. Looks like good support here, and I'm going to use all of these same similar characteristics as a way to invalidate myself, but the upside is to up here. So that's how I would think about it.
Yeah, I think that's good. I think this goes back to if the buyers and sellers in every market are connected, and if there's a large player, and if bonds go up or down, that's going to influence and impact if they're able to buy or sell, or if rates go up and they know that if rates go up, my financing costs are going up, so I have to buy this asset or have to sell this asset. I'm forced to liquidate. Then you want to know what all assets are doing, especially on the interest rate complex, right? And that's where I always say over and over, interest rates are the price of money, and every single thing is denominated in money. Every good service or asset is denominated in money. And so if you stack that knowledge, even this, very simple knowledge about SOFR and how it connects to FX and crude and equities, that's going to begin to frame these positioning extremes. And, you want to, it's executed extremes and meme in between. That's the name of the game, right? Especially if we're on Twitter.
Mm-hmm.
All right, couple questions that I wanted to go over really fast before we keep going. And
can I point one out real quick that I think would be good for you to hit first? Is this guy said blowing out is a confusing term. Would you be able to kind of describe what you mean when you say blowout? Because that can, and I was like, oh, that's a weird question. But now that I think about it, I actually think it's kind of good to determine maybe what that means to you.
Totally. I think that's good question. When did I use that?
It was about rates blowing out or like crude blowing out or whatever. Like if the SOFR curve blows out or like what does that mean?
Oh yeah, I mean all we mean when we say blowout is that we're basically saying there's some type of positioning unwind that's taking place that is forcing someone to dump their position somehow. So, for example, like one of the things that you look out at is, let's just use the simplest example. If we go to the VIX, right? These people who are trading equity markets, and the VIX blows out and moves up really aggressively like this. This is happening not because everyone is having an orderly unwind and people are saying like, oh, hey, can I sell here and you buy here? Okay, we're cool. Like, let's just go home. It's someone getting taken out. You have to recognize people are losing money here when they're getting squeezed out of hedges or whatever it might be. There's people that are selling at losses when this is taking place. And especially with the entire idea of alpha in markets, a lot of times when you make money, it's because it's at the expense of someone else. And that might be a large institution who needs to pay a premium to execute. It might be commercial hedgers or whatever it might be. So when we see these larger moves, I would just say it has to do with low vol versus high volatility. If you're saying like, what's the quantitative expression of that? it's just low vol versus high vol. And low vol versus high vol is what every quant or stat arb shop is trying to figure out so that they can, basically say, do I want to take the other side of this trend in momentum or mean reversion or something like that? So what I'm always looking at is if I have a view about interest rates and we're going to so like, for example, like 10-year interest rates right now, right? People are not positioned for interest rates to move higher in a capitulatory way. And that's super clear right now because the move index is still at these lows. It ticked up just a little bit, right? But when you have interest rates, if we say blow out to the upside, it's likely because people are having to sell at a loss right here. And maybe you'll have some buyers come in once things stabilize, but blowing out is basically when you have vol blowout and you have positioning unwind. I mean, vol rises, implied vol rises specifically when someone is typically losing some type of money or they're on the wrong side of a trade and they're forced to get out. So I think that's good. I think that's how I think about blowing out. Is that kind of fair? Does that make sense?
Yeah.
Really good questions here. I think we have a lot of good questions in here. How do you think about gold versus gold miners? How does it fit in your framework at the moment with real rates falling? At the end of the day, on the GDX side, if we're just going to talk about we're not going to stock pick and we're just going to pick a sector, then you just need to think about what is my relative performance and what's the trade-off in that, right? So if I'm long gold, long GDX, short gold, right? That can be a little bit of a cash flow component, right? But I think you need to ask, why would it outperform? And a lot of that is a little bit to do with equity beta versus, we've, I guess, we've outperformed by maybe 30%. So I think that, given that the performance is pretty close, it's not that extreme in my view. It's positive, right? Like if you own GDX versus gold, you're probably up more. But what I would think about in that position for me is, how much am I spending on margin, right? Because if I can put a smaller amount of money up as margin for gold futures, then now I have more capital to run trades other places. So that's why I typically bias a little bit more toward the future side, just because of the margin efficiency. Other question here. With Warsh as Fed governor favoring messier meetings and no forward guidance, could rate uncertainty raise the move repo haircuts, tighten liquidity moving forward? It might increase ranges a little bit. And yes, it might increase cross-asset vol just a little. I think we might have a little bit wider ranges in the SOFR complex. But what I would say is that I think he'll probably bring more certainty to the economy. And that will be kind of the interesting tension to take note of. I think they're just going to do a better job at not acting reactively and trying to take bets with more foresight at the Fed. Because you have to realize the Fed is just like a hedge fund. They don't know what's happening in the future any more than we do. I mean, they could know things that are happening a week out or maybe 2 weeks out that we don't know. But overall, those things are usually coin flips because we can all predict those with like a decent degree of error, right? Like they could get a CPI print before we do maybe, or some other type of data. But overall, they're under the same constraints as us. So Warsh's idea is to accept that, not suppress it. And instead of always being reactive and behind the curve, he says, you know what, we're going to make just as many, if not less errors, if we just try to take bets in the future with the Fed in the same way that all of us work under uncertainty. That's kind of the idea. He's just cloaking that in, I think, better language. All right. How much time does need to pass to confirm the regime and need to watch the curve for periods? Going back to this idea of the curve, what I would say is that all of us are looking at these curves across multiple time horizons. So I'm looking at the hourly, the daily, the weekly, and saying what is happening on all these curves. And you specifically want to look at what the curve is doing when volatility is blowing out. So if the standard deviation, if the volatility, if implied or realized volatility is rising, you want to look at what's happening during that period of time because that usually sends you a clear signal about the regime that we're in. All right. Couple other questions. Guys, as a side note, I don't comment on other people's views. So if you ask questions about someone else's views, I'm not going to really comment on them because I just don't have really interest in creating any type of beef or anything like that because like everyone's functioning markets in their own kind of their own stage and their own mindset. So if there's specific mechanical questions that you guys want to ask, I'm always happy to chat about those. On the link to this trading view chart, if you go to the educational primer section, scroll down, download all these models, and then go to the yield curve indicator right here. That's where it is. Go through all the educational primers. That's like basically what you need to do. All right. James, why don't you answer this one?
Yeah, I think this is actually funny because it is, first of all, not the way you spell my name. How dare you? Second of all, it is actually a perfect analogy because, all right, you don't golf, but when you go to the driving range, you are getting reps, right? But what most people are doing is just like smacking balls, no intentionality, no proper practice, not treating it as if they're on a real. It's very hard to simulate an actual on course situation. Just as hard as it is to simulate paper trading, as if you're in a real position with real pressure, with real money on the line. So, look, I'm a really good range golfer, as many people are, because I'm not on the course. I don't feel the pressure of trees to my left or right. There's no consequence, right? Same thing with paper trading. There's really no consequence unless you are able to construct and respect that consequence out of thin air. So I've always been pretty against paper trading. Like you could use it to like learn how the functionality of something works. But I think you need to get into the real money trading as soon as possible. You need to get out there on the golf course and play real golf as soon as possible to really understand what makes you tick, where you're good, where you're bad, where you need to intentionally work on things. Don't just be a range golfer. Don't just be a paper trader. People get stuck in paper trading. They never move to the real stakes. So that's kind of how I think about it. Use it to learn the functionality of the vehicle you're using, and then put real money to work, even if it's a small amount of money, as soon as possible. Like you have to feel it.
Yeah, I definitely agree with that. I guess I've paper traded things to learn, like what you said, functionality of a platform, so I don't just make execution errors.
Correct.
And then I think I'll run paper trades sometimes if I'm like, well, I want to test out like running these trades on this strategy that I made and just see what happens, right? But I'll always.
But even that, right? Even that like doesn't properly fill your trades, right? And if you're using size, it
Totally.
it creates a false representation. I remember paper trading early on, and I was like, "This is great. I'm on sides like every single trade." But it was because like my trades didn't have any slippage or anything, and it would just simulate me like getting perfectly filled in and out every time.
Right.
I didn't really get it. So
yeah, I totally agree with that. I mean, I just think at the end of the day, like reps are about intentional iteration with real feedback, and paper trading doesn't give you that. So
yeah, and I think people think paper trading is going to help save them money or whatever in the long run. It's not. You have to pay the tuition. The tuition is real money. Again, it goes back to the like you're trying to suppress the volatility of this world that is inherently volatile. And if you don't accept it and look forward right into the face of volatility, you will fail. Guaranteed.
Totally. I just want to clarify this. Someone said, you said there's no downside in Z7. I never said that. I said there is limited downside in Z7 as long as
No. You said for sure that can't go down anymore.
Okay, listen, this is a great example. If we have crude blow out to $140, then yeah, Z7 is almost certainly going to make a new low. So what about the scenario? Yeah, that's a scenario. Do I think that's going to happen? Probably not. And I don't really want to bet on it. And we're already at an extreme. And so if that scenario happens, then I would get stopped out. And right now, I am being careful about taking weekend risk because we're still having all these, I'm more trying to fade weekend risk when it happens than trying to get super aggressively positioned on a Friday for no reason. And, when you can have these type of military escalations. So, yeah, I just think, again, think about the scenarios. At the end of the day, there's always, you should have a risk for every single trade that you take. If there's no risk, then you better figure out why exactly you're getting paid. And I think a lot of people are trying to find trades without risk. And in my entire view, I am just trying to find the risk that I want to take. Just take it, take the vol, and just be a savage and stop complaining. That's how I think about risk.
Also, I just want to add on, put that question back up. Read that question a few times to yourself and realize the problem in that question is that you're not hearing it right. You're not listening to it correctly. You're listening in a way you want to then eliminate a potential outcome to then like make a bet. That is not how trading works. It's all on a probabilistic curve. It's never this can't happen, this has to happen. Like the way you've written that question just makes me think you're hearing it in flow saying there's no downside here. That's not the case. Go rewatch it, re-listen, and reframe the question. And I'm not trying to be a dick. I'm just saying maybe think about how you wrote that question and how maybe you should try to interpret it in a probabilistic fashion rather than binary on, binary off.
Yeah, agreed. Definitely agree. Other question here. I actually like this one because I think it's a good question. And also, I think we'll get into this idea. Why would a person be forced to sell a bond? Are they traded on leverage like equities? If you think people use leverage in the equity market, just wait till you meet a bond trader. I mean, like bonds and FX, there is way more leverage in that market than there is in the equity market. Way more. Like just so much more, especially with how bank balance sheets work and how financing for that works. I mean, it is insane. So yes, people trade. I mean, that's what futures are for all these products. And they're the most liquid markets in the entire world. So yes, people get blown out of bonds all the time. I mean, some of the most savage traders in the world are in the rate and FX market. I mean, that's like the entire bread and butter of Paul Tudor Jones, right? Is rates and FX. So I always have, why I think you have guys who use so much size there. It's always pretty insane. There's this idea that the bond market tells the truth and the equity market doesn't. That's just completely false. I mean, there's no evidence of that. I just think it's a very misleading comment, and it kind of represents you haven't even traded rates before. But the rate market can be just as wrong, or whatever you want to call it, mispriced as an equity market. So that's what I would say.
Yeah, go look at the bond futures books too, and tell me you don't have to use leverage there because like they're not moving like other things, right? Like you go look at ZT or ZN futures or something, look at the daily range. Like you got to size, you got to add some size. You got to get leverage.
Totally. I want to go through a couple more of these questions real fast because we're going to end in a little early today. But did T-bills move ahead of the Fed interest rate decision? It's not really the right question. What we have are different interest rate curves. We have T-bills, you have SOFR, you have Fed funds, you have these different parts of the short end interest rate complex, what we call short-term interest rates, or STIR. And you can go read the Conk's Substack where he talks about that in depth. There's a lot of different ways that premiums, discounts, liquidity are priced in that complex, but there's not this like thing where T-bills, Fed fund contracts and SOFR contracts price the actual meetings, and you have, T-bills are the actual issuance. Those SOFR and Fed funds are derivative contracts. T-bills are the actual bills that are issued by the Treasury, and all of those interest rates with some spreads for premiums and discounts, depending on where we're at in the system and how we have reserves in the system, move in lockstep. So it's not like, oh, do T-bills lead and no one knows about that or something like that. So I would say, spend more time reading the interest rate books on the Substack and going through some of the stuff on the Conch Substack, because I think those are going to be helpful for that. Does gold look strong here? I think it looks like a great spot, especially post FOMC. If we don't hold these levels post FOMC, then I would be a little less aggressive. But I think we're going to, move up here and hold these levels. If we don't, then I'm going to basically be wrong and basically stopped out of that. But I think, I kind of talked about this, that I think if we can stay above after those hedges unwound for FOMC, I think it's going to hold that level, especially with that Z7 contract and FX and things like that. All right. How do you think about balancing learning a new market, say oil, gold versus trading the known market? James, why don't you touch on this a little bit?
I've told some of my in my Discord, actually, a few guys to explore, because, well, sorry, what does he mean by the known market?
Well, I think it's kind of this idea of if I'm already really good at one place, how do I balance just executing there and being consistent when I have like a limited amount of time and learning another market, if that takes away from my current trading or stuff like that?
Like their known market, I suppose.
Yeah.
I would say, just like if you're a futures trader or something like that, or I guess if you're single stock or something like that, you should go learn the index, see what options are. But I think you just size way down and just go take little bunts, take little singles, start to learn the flow, the average ranges of the day, feel the volatility, bring up the oil VIX, bring up the gold VIX, like start to just put on a very small insignificant position for you, and just learn how it feels. Because like in futures, there's so many people that just jump right into NASDAQ futures or E-minis or whatever. And I'm just like, man, there's so many other options that are so much better vehicles to learn in, right? Like live cattle is making all-time highs every day. Like go to like LE1 and just give them a weekly LE1 chart if you can.
What is it?
LE?
Oh, yeah.
Like, right? Like, dude, I mean, this is a global commodity breaking out to all-time highs. And like these things could go limit up, they could go limit down. There's real paper in the book. Like this is exciting trading can be in there. But for some reason, people are like, well, that's weird. It's like cattle. Who cares about cattle? Bro, you could size up and make more money in cattle than you're ever going to make in NASDAQ futures trading against the best in the world. Like, why are you not exploring that? Why are you not trying to trade soybean futures around WASD reports? You probably don't even know what a WASD report is. Like, there's so many cool options out there in futures. There's nat gas, there's rates, there's currencies, there's ags, there's softs. I mean, I traded a ton of cocoa. Like Flows knows all about that, right? Like there's all sorts of things.
We have to go over the cocoa story one day.
Yeah, pretty much ruined my career.
Was it your greatest moment or greatest downfall? Which one was it?
I'm not sure. Maybe in a few years, I might look back and be like, thank God that happened, right?
Yeah.
Or maybe not. Who knows? So it could be an inflection point, a chocolatey inflection point in my life. But yeah, like I mean, I'm looking at that chart and I'm like, I want to be trading that. Yep. I don't want to be trading something stuck in the middle of a range with a bunch of confusion and relying on Trump tweets. I want to go play that price discovery breakout in a commodity that's never been at that price. And then, since people aren't looking at this, right, I will understand that when I see a Kobisi letter report tweet about, oh my God, cattle prices have never been higher. Well, that'll probably be more near the top. You know what I mean? Because I've been watching this for a long time, and I already know that. You're going to have people tweet, you'll have these guys out there tweeting about steaks are so expensive now. Those are the Forbes magazines of cattle trading. So it's just like, go explore, use a one lot, like, come on.
Totally. Yeah. Great points. All right, everyone. Well, we're going to pull a couple things together here as a reminder. for everything that James talked about today, all the things that I talked about. We didn't get through the entire slide deck. I'll cover it a little bit more tomorrow. We'll go through inflation swaps, how it connects to real rates, how it connects to nominal rates and things like that, and go across the risk curve right here for duration. And we'll talk about that a little bit more, but everything will be laid out on the Substack at capitalflowsresearch.com. So if you haven't gone to the website yet, again, all the educational primers are here on the main page for free. And then you can go through all the articles that we're going through every day. And then, if you guys are, here every day on the live streams, that is just going to be an investment that you're able to consistently stack the knowledge, all the little lessons that you are learning, that we're learning. And we're going to keep going over all of these lessons on the mental, emotional side, on the decision-making side, and connect them, right? Like, I think a lot of people, they're just having one of them, right? They'll just talk about the mental game. They'll just talk about like a market, or they'll just talk about one thing. And our entire goal is pull all those moving parts together and be able to understand how to make money in real time on that. So these streams will be every single day, 8:30 a.m. Mountain Standard Time. And I'll lay out all of these reports on the Substack afterward. James, any final closing thoughts as you're back in San Diego in the vibes?
We're back in the vibes. No, if you guys want to follow my work, just go to my YouTube channel or watch my shit posting on X. I'm on a heater right now, so I would say, now that I've said that, fade everything I do.
Yeah, everyone,
never recognize your heater. That's like a screenshot. You never screenshot your.
All right, everyone, go to all of James' work on his YouTube channel, James Rosenthal. All the stuff is on capitalflowsresearch.com. And with that, we will catch you guys tomorrow at 8:30 a.m. We'll catch you guys then.